Welcome to this week's market drama. We'll begin with the S&P 500, which was down 2.1%. NASDAQ was down even more, down 3.4%. The bonds aggregate index was up 2%. It is now up 2.1% for the year. This week, actually, NASDAQ is now up 11.8% for the year. S&P is now up 12.1%. So NASDAQ is actually now underperforming the S&P 500 this year. That S&P 500 drop of 2.1% is now giving us a 5.7% drawdown from the highs we saw in July. So this is the largest drawdown, right, or drop that we've seen in the stock market this year. And it is important to remember that these type of drawdowns, this type of volatility is actually fairly normal. If we look at the last 44 years, on average, there's a 14.2% drop. And yet 33 out of those 44 years, the market still ended up, right? That's courtesy of JP Morgan for that data point there. And I think it's an important one, right? This is fairly normal. And the underlying fundamentals still remain fairly strong. If you look at what's drawing the market down, is a lot of the technology stocks that have been high flyers. Underneath the surface, the broader markets has been holding up better, sectors like financials, industrials, et cetera. So what's going on? What happened? What data points happened this week that might have continued this trend? Well, the Federal Reserve met this past week. They did not do anything to interest rates, but the Federal Reserve did have a chairman did have a quote. He said, "The job is not done on inflation. Nonetheless, we can afford to begin to dial back the restriction in the policy rate." He had not said comments like this in the past. If you read between the tea leaves, and the market is, he's saying by September, there's a much higher likelihood that the Federal Reserve will actually cut interest rates. We also had data from the job market, right, for July payrolls that showed that the US economy added 114,000 jobs. The expectation was for 175,000 jobs. Also, the unemployment rate jumped up to 4.3%. The consensus estimate was for 4.1%. Lastly, wage growth increased at 3.6% year over year, which was lower than expected, right? So if you're sitting there at the Federal Reserve, you're looking at, they have two mandates, right? Is inflation and then the economy, or jobs specifically. And you're starting to see kind of the shift here from inflation is now, core inflation is at 2.6%, and employment's cooling off, right? So it's probably time in their mind to start being less restrictive with interest rates. So that explains a lot of the moves, right? Bond yields dropped, and high flyers tech stocks have sold off because those were really not the ones that were driven by interest rates as much. The ones that were more interest rate sensitive were the cyclical sectors that are actually still holding up nicely, despite all the volatility that we've seen on the more tech heavy indices like NASDAQ. On the other front, the last thing that I'll mention about last week is we had earnings from a lot of these tech companies, and they continue to perform fairly well. And it's actually not just the technology stocks. The biggest upside surprises for earnings are coming from cyclical and defensive sectors such as financials, healthcare, and less so from the growth sectors, right? So earnings are holding up. The Fed is signaling that they are actually likely to lower interest rates, and the job market is cooling off. So it's not only inflation that's cooling off, the job market is showing up cooling off, which would potentially lead to a cool off in the wider economy, right? We don't know if that would be a recession or just lower growth. Either way, this is kind of the shift that's happening in the market, and therefore we're seeing bond yields come down, stock market showing more volatility. So that's it for this week. Stay tuned for next week.